All right, let's see. The markets close. Yeah, interesting day today. So I'm giving people a chance to log in. But again, interesting day. As you guys know, market's up. You had several things run. Actually, almost everything ran except for energy stocks. And of course, a couple of the tech stocks that have led this rally have pulled back a little bit today. Basically profit taking. I don't think it's anything major. So I'm going to give this a few minutes more, then I'll start. I think it's going to be a very interesting call today. Very interesting. All right, let's see. In my office here, it's like a little oven. It's hot. AC's blowing, so hopefully I'll cool down in a couple of minutes. All right. Well, I'm waiting for some people, but they're not here, so I'm about to get started. And I'm just looking to see now if there's any questions. There's no questions. I have had some questions, which I'll talk about. In fact, I see Lance is here, and I know Lance had a couple of questions. So as I wait for everybody to log on in, let me deal with this. Lance, I got your email, your message concerning me going over the commitment of trade report, the COT, and how to read it. I will not do that today because I just don't have enough time. I already had planned out what I was going to talk about today. So what I will do, though, is I make a promise that next week we will dive into the commitment of trade report and go through it. So I definitely will do that. All right. So, in fact, I'm writing myself down a note, commitment of trade report, COT. All right. So let me get started real quick. I see. So welcome to Wall Street Wednesday. What's today? Today's September 2nd. Market was up. I'm looking now. Market ended up being up, 400 points and change. S&P's up big. So everything basically rallied today except for a couple things, except for the energy stocks and except for pretty much the stocks that have led the rally. Tesla has backed off a little bit, which was expected. Apple backed off, which was expected. And then the one I'm going to talk about that we talked about last week is Zoom. And Zoom has backed off a little bit. All right, so let's get started. First and foremost, I, Professor Milligan, am a student of the market. I wish I wasn't wrong when I'm wrong, and I wish I was right more often, but I'm just human. And so myself had to learn a lesson again this week. So if you remember last Wednesday, we sat here and I said, wow, Zoom looks really good. I'm looking at that chart. I'm looking at the earnings and what's expected. And I said, when I get off this call, I'm going to go long Zoom tomorrow. So the next day, I went through, looked at Zoom, went up and down, looked at it, and I put together a synthetic on it and did not fill the order. And major part of the reason I did not fill the order was just like all you guys. Okay, looks like I'm back. I do apologize. I also just plugged in my hotspot, so between the two of them, hopefully I can get this going. So, let me get this off the table. So as I was saying earlier, last week we talked about Zoom, and I told you how I liked the chart, I liked what was going on, I liked the action. I said the next day I was going to buy it. So what I did was I went into put together my synthetic on it, which I did. So I put my synthetics on it, and as I did that, I apologize. As I did that on Zoom, so again, I put a synthetic together on Zoom last Thursday. I watched the stock trade, and I looked into it, and I literally backed off. I backed off and said I was going to wait until after the number came out. Now, the reason why I had done that is this whole earnings season, I had picked a number of stocks that beat on revenue, beat on earnings. The stocks were running ahead of the number. And once the number came out, the stocks backed off. So with that in mind, I decided I was going to wait until after the number came out and then trade Zoom then. As I always tell students, and I tell you guys, and I tell myself, Zoom doesn't know Apple, Zoom doesn't know Facebook, Zoom doesn't know Walmart. They're distinctly different companies. And I should have treated Zoom independently and not let my past experiences influence me. The system works, the strategy works. And so long story short, I did not go long Zoom. Now, if I remember correctly with those numbers, that Zoom position at the time and the synthetic was going to cost about $2,500. That was a hedge synthetic. So again, long a call at the money, short a put at the money, and then long a put at the next below strike price. I believe I was working at the $300 level when I put it together. So to make a long story short, as you guys know, Zoom ran ahead of the number, ran after the number, ran, and with that run, that position that cost $2,500 went up as much as to 50 grand. So it was, I just missed it. Now, as I tell you this, I tell you that because one is, it's not the first position or trade I missed, and it won't be the last. So the good thing to take from that again is that the strategy does work, and I just missed it. Now, last Thursday also, at the same time, I got a buy signal on the market. Now, you guys have heard me talk about the VIX, the VIX. The VIX gave me a buy signal last Thursday. So instead of going long Zoom and going long Zoom, I went long the S&P. So I'm going to show you, see if I can find it. What you're looking at now is the actual position I put on the S&P. So the top is, I went short, the top is my hedge. That's the S&P 349 put, I went long, that's the hedge. At the time of that trade, it was $5.63, I believe that's where it was. The middle trade position, is the long call at 350. So I went long the call at 350, and then right below that, I went short the put at 350. So what you have here is a hedge synthetic. If I remember correctly, I believe my cost was around $600 or $700 when everything was said and done. I wrote those numbers down. I think it was $670, so basically $700. That's what you're looking at. I pulled this up earlier today, and I'm not sure where Zoom, where the SPY closed at, but when I pulled this up earlier today, the SPY was, as you can see, the short put, believe it or not, if you're short a put, which is my hedge, you're actually bullish. So the short put that I paid $6 for, $6, almost $6, for $5.63 I paid for, is now trading at $3.44. For those who don't know, that means I sold it at $5.63 and I could have brought it back at $3.44. The difference between the two is the profit in my pocket. So I made money on that short put. Let's see what else. On the long call, the long call, when I did this was at 9.75. The long call actually right now is trade as high as 11. It closed at $10.90. So basically another point from here. And then the short 350 put, which is at 365. Actually today it closed at 345. So lost some money there. When you actually did it, the whole net position, right now the position's up about 40%, 45%. Not bad for 2 days. And again, it's hedged, so I'll let it run. Now, as I mentioned just before this, I used the VIX, and the VIX gave me my buy signal. All right, I got the signal to buy the stock from my VIX. So let me do this real quick. So last Thursday, I got a buy signal on the VIX. All right, and again, I talk about the VIX all the time. The VIX stands for the Volatility Index. Just a quick refresher again. What they do is they take puts and put puts in the numerator and calls in the denominator. All right, puts in the numerator, calls in the denominator. They typically are on average about 30-day expiration. So these are actually short-term puts and calls for the S&P, 30-day expiration. So you're looking at what's going on near term. Now follow me. If investors are bullish, they're going to start buying calls. As they buy calls, the premium in the calls is going to increase. As the premium in the calls increase and the premiums in the puts decrease, as well as there's more call buying than put buying, the VIX is going to actually go down. Now, as I mentioned to you, and I'll mention it again, the VIX can run on the low level for an extended period of time. And the way I call that is market enthusiasm. Everyone's exuberant, enthusiastic about the market. Everyone wants to own the market. So what happens is that VIX goes down and gives you basically a signal where the VIX is very bullish. So that's on the bullish side. On the bearish side, when fear comes into the market, the premium in puts spike up and the number of puts being traded spikes up compared to calls. And that's when you see the VIX spike up. Now, I'm going back almost, 12, 13, 14 years. I did a research paper, a white paper on the VIX and the correlation between the VIX in terms of a buy or sell signal and the S&P 500. I bring all this up to tell you this, that I took the VIX and separated it into two distinctly different signals. So one signal I get is, I'll get a signal that when the market is overbought and the market should be sold. In other words, you should get short the market. Now, the reason why I bring that one up first is because that signal was not very accurate. It was giving me a signal, but the signal wasn't very accurate. And the reason being is because especially when you're in a bull market, all news becomes good news. Everything becomes good news. And the market keeps running even when I got that signal to go short the market. I know one of my former students is on the call, and we had this discussion in class one day when he was calling for the market to pull back. And I said to him, look, that sell signal you got on the market from the VIX, it could actually be 2, 3, 4 weeks, 5 weeks ahead if you even get one. I said, so it's not very accurate. Now, on the other side, when the market sells off, the VIX is really, really accurate. So what I mean by that is when the market sells off is when the VIX spikes up. And when the VIX spikes up, it typically is telling you it's a buy signal in the market. Now, what I've done was to increase the returns, increase the percentages of being accurate on the VIX. I married the VIX to the Bollinger Band. So let me do this first. Let me show you. Now, I know this is hard to see, but I literally got this off of the Fed's website. I'm telling you, the Fed has some of the best information out there. The red line that you're looking at is the S&P 500. The blue line is the VIX. And I know it's hard to see, but like I said, hopefully you'll go back and you'll look at the video on this. I'll post it on, post like I always do. And when you look at this video, you'll notice that when the VIX spikes, it's usually near a market bottom. And when the VIX spikes like that, it means that investors as a whole have become very bearish on the market. The problem is that most times they're wrong. They become bearish at the wrong time. So when the market starts to sell off, they don't become bearish when the market starts to sell off. They usually become bearish when the market's near a bottom, near-term bottom. So that's how I use the VIX. Now, when you get a buy signal on the VIX, in other words, when you get a signal to buy the market, I don't know if that signal, haven't done this, I don't know if that signal is going to last, or that upward momentum is going to last a day, a week, or a month. I've had several that lasted several weeks. I've had some that lasted 2 or 3 days. But again, that's typically what they do. I got a buy signal on the VIX last Thursday. Got it confirmed again on Friday, and believe it or not, it's happened again on Monday, even though the market was up. And what happens this particular time is this, and I've seen this happen before, that and you guys have heard this, that there are certain people out there, quote unquote, that anytime a stock or the market hits a new high, they'll come back and say, the market's too high, the stock's too high, I'm going to short it. And so they're not shorting off any fundamental reason. They're basically shorting because of fear of that it can't go any higher and there's going to be a pullback. That's happened a couple of times in the past couple of years, and those are extremely bullish. It happened on Monday. All right, on Monday we got a buy signal on the VIX as the market was going higher, and what that basically was saying is that there was fear in the market from investors that the market's going to be going down because it's too high. I know it doesn't have any logic behind it, any sense, but that's what's going on. Now, if you bear with me a second, I think that's it right there. So I know it's kind of hard to see, but you can see that last Friday, which is a long green bar right here, last Friday, the VIX spiked up and closed above the Bollinger Band set for 2 standard deviations. What that means by going above 2 standard deviations is you went to an extreme tail. You went out to the tail. So those who understand math, you understand what I mean by going out into the tail. It went to the negative tail. Now, for those who don't understand, I guess the best example I can give you is that it was so oversold. That's what that's indicating to you, that the market's going to bounce. Now, it wasn't oversold, but that's what investors thought it was. And you can see that the next 2 days, yesterday and today, that the VIX again was above the upper Bollinger Band. That's my buy signal. I went long. All right, so I went long, and that's how I got long on the S&P 500. Now, with that said, I'm just writing myself a note for you guys. With that said, now I put a hedge synthetic on, and the reason why I put a hedge synthetic on is because there can be some pullbacks. I'm looking for it now, and hopefully I can find it. I did take a picture of. I didn't take a picture of. So that's the reason why I can't find it. But I can find it. Let me see. Well, I can read it to you. So bear with me a second. I'm going to read this to you. And as I read it, I want you guys to write down these dates. And the reason why I want you to write down these dates is I went back a couple of weeks, and I went back to 2019. And what I did was I wrote down the dates, all the dates of when the VIX penetrated the upper Bollinger Band. Now, the reason why I'm giving you these dates is when you have some time, go back and look at the S&P 500 and look at what it did on that date and after that date. So let's see, where am I going back to? So the oldest one I have here is December 2nd, 2019. December 2nd, 2019. Then I have, I missed that one. October 2nd, 2019. So October 2nd, 2019, then December 2nd, 2019, then January 27th, 2020, June 11th, 2020, and then again, August 27th, 2020. I'll read them all over again. I really want you to go back and look. October 2nd, 2019, December 2nd, 2019, January 27th, 2020, June 11th, 2020, and August 27th, 2020. As you look and study that, 2 things. 1, look at what the S&P has done with that. And then 2, look at what would happen if you had just basically brought one call or actually brought the S&P 500, what your returns would have been if you had done those. And that includes one or 2 times when the signal didn't work. So it's not 100%. This is the reason why I hedge it. But it does work. All right. I think I don't see any questions on the VIX. I promise you that this weekend, amongst other things, I will work on a full-fledged presentation on the actual VIX. I'm finishing up one right now. And when I finish that one up, which is basically I'm finishing up the one right now on the VIX, and I'm working on that. So I started pulling the data together. And when I get done, I'll post that on my Professor Milligan channel. Yeah, I just talked about that, Tommy. The VIX moving up, because people got bearish because the market went to a new high. And so they all started shorting the market. I've seen it happen before. And by the way, for those who are on the call, Tommy, who just posted, Tommy's one of my students I know for a fact was very, very, very active in the VIX. I remember Tommy even calling me from, I think, Tommy, you were at the grocery store and saying, Professor, I'm looking on my phone and I just got a buy signal on the market and from the VIX, and I'm going long the market. Was going to say, so that's who Tommy is, and Tommy and I have had a number of discussions about this, and I think Tommy's but you have a testimonial that he's used the VIX, traded the VIX, and followed this strategy, and it's worked extremely well for him. The one thing I will say about the VIX again, though, the hard part about the VIX is that when you get a buy signal, in most cases, the market has sold off that day. So you literally could be going into the market, buying the market when the market's down 200 points, 300 points, 500 points, 1,000 points. You might get a buy signal in. And most of my buy signals on the VIX have come on days when people just don't want to go long the market. So that's the reason why, one, I don't have my dates in front of me. Back in March, let me just delete this. Back in March, there it is, March 23rd. So I got one here in February 28th and one in March 23rd. That's when the market started selling off because of the pandemic. And what's interesting is the VIX gave a buy signal on February 28th, and the actual market ran up a little bit from there. So you would have made money on that one. And then on March 23rd, it gave another buy signal, but what happened was the market kept selling off. So out of the, 6-7 times I looked at it over the past 12 months, there was one time where it gave you a buy signal in a bloody day, and that kept going down for the next 2 or 3 days. So again, when you do this, allow yourself some time, and whenever possible. So let me see what this is. So again, if you read what Richard Rivera wrote, so Richard was another one of my students that also used the VIX strategy. And I remember that, Richard, we in class, and I think if I remember correctly, you sold it like after 2 or 3 days. And I got on you because you sold it for no reason. And the S&P continued to run for like almost 2 or 3 weeks. And you looked and said, wow, look how much money I would have made if I had just stayed with it. So what Rich is talking about is the strongest signal I get on the VIX is when it penetrates the upper Bollinger Band for the VIX and the S&P 500 is trading below its 10-day moving average. Those signals are the ones that just really rock and roll. So again, that's the VIX. I have a number of former students on this call who have used it and traded to their advantage. And so I highly recommend it. Even if you're not going to trade the VIX or trade the S&P, understanding the VIX and its impact on the market or what it's telling you about the market can also help you. Now, the other thing I'll say, I know I'm saying a lot about the VIX, but usually, and those who I've taught this to in the past know that I'll get a buy signal from the VIX on the S&P, but typically I would go long the Qs, the NASDAQ 100. The reason why I would go long the Qs is because the Qs typically have more volatility in the S&P and you get more bang for your buck. The reason why I did not do the Qs this time is the NASDAQ 100, and you know the names, the NASDAQ 100, Microsoft, Intel, Apple, Amazon, Google, that's the NASDAQ 100, the Qs. So you know the names. So what happened here was that I lost my train of thought when I was just doing this. I do apologize. Part of the reason I lost my train of thought is, again, my mind's doing 3 things at once. But anyway, normally I would use the Qs, but the reason why I didn't use the Qs is because there's been a separation between the Qs and the S&P and the NASDAQ and the Dow Jones. There's been a separation between the two. So that's what's going on there. So that's the reason why I didn't use the Qs. But again, you can, if you use this, you can tell that when the market sold off, you get a buy signal. You don't have to buy the market. You can actually buy an individual stock, especially one that's highly correlated with the market. Typically, Apple's highly correlated with the market, but Apple's pulled off today. All right, that's enough about the S&P and the VIX. Hopefully, you guys are making some money with it and using it. Let me get out of that now. Now, the other thing I had some questions on is in terms of volatility on the options. I don't look at volatility when I trade options. And the reason why I don't look at, and by the way, volatility are the Greeks, so for those who don't know, if there's an increase in demand for a particular security stock, then those options will actually go to a premium. So, if a stock has been moving higher, advancing, there's more volatility in the option because they're going to increase the price because of volatility. Now, the reason why I don't look at the volatility is because most times with me, I'm buying the option or synthetic instead of buying the stock. And because I'm either selling a put or selling a call that actually collects some premium, if there's volatility in there and there's more premium in the option, it's to my advantage. Hopefully you understand what I'm saying. So I'm not concerned with the volatility. One other thing to think about, when you look at my synthetic, understand this, the money I collect from selling that put or selling that call, the hedge, is going to lower my cost for the whole scenario, which means it lowers my break-even point. So case in point, if an option costs $7, then you know that your break-even point is going to be $7 above where the strike price is. All right, that's what you know, give or take. I'm talking about intrinsic. I'm not talking about any volatility. Well, we also know that when I sell the put and use that to help pay for the premium, that option now, that call that I'm long, instead of it cost my break-even being $7, my break-even can actually be lowered to $6 or $5.50. And there's been some cases where, because of some premiums that I collected, that it could even be more than that. So because it lowers my break-even point, and because it lowers my break-even point, it gives me a better chance of making money. Hopefully everybody understands that. So again, I'm not trading volatility. Some of you guys know that some option traders do trade volatility. When an option has more volatility than normal, so it has more volatility, they'll actually short the option because they expect that volatility to come back in. And if the volatility is too narrow, it's trading it below its average range, then they'll go long, expecting that volatility to increase the price. I just don't trade volatility. So, option volatility. Okay, the other thing I got today, checking my time, so good, we're ahead of time. The other thing I got today was I had a couple of messages concerning a couple of stocks. So one of them I looked into, one of them was Chewy. Chewy's due to report earnings. I'm pulling up the stock now. Chewy's due to report earnings on the close on September 10th. If I remember correctly, that Wall Street's expecting a loss of about, I think, 15 cents. If you look at Chewy's chart, which I did, Chewy broke out 2 days ago, and it went from $62 a share. It ran from 62 to looks like a high of 75 before closing at 70 today. So that's Chewy. I'm not sure how to play this. As you can see, there's been a huge spike ahead of the number. I cannot find any reason for the spike. Doesn't mean that there's not one. I just can't find it. So I'm not sure what to do with this. The other thing is, I understand that they're a retailer, they're a specialty retailer, they have a certain niche, and they sell basically pet products and foods, and they do it online as well as they have stores. But again, I'm not sure what's going on here, so I'm not sure about Chewy. I'll keep watching it. Chewy did bring up one thing for me, which I need to make a note for you guys. Tesla, Apple, and Zoom. I'm going to start with Zoom first. I got an email, in fact, a message from Richard Revere, and Richard was asking me about Zoom and if we should short Zoom here. Again, Zoom had a run basically from $300, from 300 to 440, 445, if I remember correctly. I'm pulling it up now. And yeah, so Zoom broke out. So it broke out from 300 on Monday, and then closed at 325, and gapped open the next day at 440, going as high as 480. So here's the deal when you look at the chart, and Richard asked me, is this a short? I would be really nervous shorting this stock because the numbers that they put out are doing really well. So they're showing that business is doing really well, and that it's not going back. In other words, we're going to continue to do everything online, like we're doing now, Zoom conference. I don't think it's even when the economy opens back up, it's still going to be Zoom. So with that said, I don't think the stocks are short here, but I do think, and anyone that's kind of done technical analysis, I do expect the retracement, the Fibonacci's. So you got a huge gap here between 330 and looks like about 411, 410. You got a huge gap here. So I would not be surprised to see this thing retrace back to the 380 level, 370 level a little bit. If you do see any type of weakness like that, if you're a long-term investor, it's probably a good chance to step in and start buying some. But I do expect the retracement. I do not expect it to retrace all the way back to the 320 level if the market holds up. And again, as you guys know, anything's fair game if we go into a recession or the market pulls back. We're already in a recession, but if the market pulls back. But again, I do expect this gap to close. And I'm looking now, anything down here in the 375, 360 level, in that range, I'd be going long for long-term investors. As a trader, I'm not trying to pick bottoms. I'm not very good at picking bottoms. Now, Tesla and Apple. Tesla and Apple both ran prior to the split. We talked about it. There's a strategy out there called stock split accumulation. So that's a strategy. It's a legitimate strategy. And so when these companies announced the stock split, I had a couple of calls and I told people, I said, look, go long now. Just go long. I'm not a fan of Tesla, as people know. I love the product. Not a fan of the way the company's run, managed. But I said, go long Apple. And now after the split, you had a pullback today. Again, there's nothing wrong here. These are just retracements. Now, again, I'm not a fan of Tesla. I'm talking about Apple. I'm not a fan of Tesla's company. A great product. But again, I did expect the pullback. These are Fibonacci's. There's a slight retracement. You can't have a run like these stocks ran and not have a pause and catch your breath. In fact, if you're a trader and investor, you want to see them pause, consolidate, and trade sideways for a couple of days, couple of weeks. All right? That will shake out the fast money that doesn't want to be there. It'll give the long-term money a chance to actually buy more position and hold up. And then after they clear all those sellers out, when they consolidate, the stock should run again. So again, on Apple and Tesla, anytime you had that kind of run up, I would expect a pullback, a retracement, some retracement, no more than 50%, if that much. Expected to trade sideways for a while, and after trade sideways for a while, then have another breakout. So for those who like Tesla and Apple, it's a chance actually to buy stock if you're very patient with it. All right, so that was that. So I did that. And I talked about Chewy. The other one that I was asked about was a company that was going through an acquisition. And I do not like trading stocks once they've come into agreement that they're going to be acquired. Once a company announces that they're going to be acquired, whether it's friendly or unfriendly, they get an offer or unfriendly, a couple things happen. One is the stock's going to run to that stock price of where the offering is. Now, here's how to look at this. If the stock is trading after the offer, whether it's a hostile takeover, a friendly takeover, after you get a price, the offering price, if the stock is trading less than 10% discount to the offering price. So let me give you an example. If the acquisition price that they're talking about is $70 and the stock trades, doesn't trade at a discount more than 7%. So let me say it again. If the stock is trading at $70, we got an offer $70 and the stock's trading $63, $64, $65 or higher, then what that tells you is when it's higher than that, that the street pretty much expects the deal to get done, and they also expect, they don't expect a higher offer. All right, so that's what they expect. If you see the stock trading above the offering price, the acquisition price, let's say again $70, you see it trading at 71, 70, 71, then the street's telling you that they're actually looking for another offer, a higher offer from someplace else. And if the stock is trading at greater than a 10% discount, a $70 offer, and the stock's trading at $60, $59, it's telling you that the street does not believe that offer is going to work, and nor do they see any other bids. So I'm just telling you that. Reason why I say that is I don't trade those for that reason. And the reason why I don't trade it, let's say the stock got an offer, like I said, at 70, stock's trading at $65. I don't have that much upside potential. The upside potential I have is basically $5, but I got a lot of downside risk because if that deal ends up being canceled, doesn't go through, the stock's probably going to move back to where it was trading at before the offer. So typically when it comes to acquisitions like this, either I'm in before it happens, and most times with me it's luck because I don't really go out looking for companies that I think are going to be acquired, or I don't trade on that takeover news or noise. So for me, in most cases, if it's going to happen, that's great. I'm only going to make $5. If it doesn't happen, stock's going to retrace and go back to where it was before the breakout, before the announcement, and could even go lower because of heavy selling. So you have more downside risk than you have upside potential. So that's the reason why I don't trade acquisition stocks. So for those who missed on Chewy, what I was saying on Chewy was that Chewy's due to report earnings on the close of September 10th. Stocks had a tremendous run up, and I don't know why. So I'm going to watch it. I'm not sure how to trade it. Now so that's what I was saying on Chewy. Now before I forget, I got to do this. And bear with me a second. Here it is. So, I'm giving you my commodities update. So my commodities update is what I've been seeing, and it's pretty interesting because I started to build a position in the euro and I stopped. But here's the recommendation. The recommendation is this. For August, for commodities, I've got nothing on the long side. I have no recommendations on the fundamentals on the long side. On the short side, I've got, let's see, what do I have here? Two currencies, the Swiss franc and the euro. And the euro actually is at the bottom of a trading range. It broke below its 10-day moving average. It's at the bottom of a trading range at support. And so, again, I'm laughing at myself. I started to build a position in the euro, and I stopped, and I'm looking to go back and build that position in euro. So on the short side. So I'm looking to do that in the next day or two. What else? On the short side, heating oil. Short side, heating oil. High-grade copper. High-grade copper, coffee, and sugar. So I'll read them all over again. So my recommendations are on the short side, heating oil, high-grade copper, coffee, sugar, Swiss franc, and euro. And again, I'm telling you right now, I am looking to build a short position in the euro tomorrow or Friday. That's what I'm looking to do. So just so you know, so that's what I'm looking to do. As I said, I started on the euro and I stopped, and I'm going back. It broke the 10-day moving average. It's at the bottom of the trading range at support. If it breaks its support, I don't remember the numbers off the top of my head, but if it breaks that support, You should see a nice move. Now, I'm just going to remind you of this. When it comes to commodities, these are not short-term trading ideas. These are not where you go in, grab a couple of quick points, and then get out. I'm actually looking for a reversal. And when you get a reversal in the commodities market, it means that the commodity has gone from where accumulation to maybe where they're selling it off, of where they're selling it off to actually where they're starting to accumulate. So I'm looking for the euro to go from the bullish move it's made to a bearish move. I'm looking for a turn right there. So that's what's going on. All right, it is basically I got 15 minutes left, give or take. So I'm willing to answer any question that you might have right now. I don't see any questions. So again, just to recap again, I got a buy signal from the VIX, went long the S&P 500. And by the way, if you've actually went to my YouTube page and saw the recommendation I put out on the S&P 500 in terms of synthetic, that I believe was done at 338. That position right now is worth, I believe if I remember correctly, it cost $700. That position when I checked based on the numbers, I mean I can do a quick number right now. If we closed at what, 11, S&P closed at what? Bear with me a second, I'm just looking for the S&P. Closed at 357. So 357, it closed at 357. All right, there you go. That position that costs $700 right now is worth about $2,000. So that's what hedged synthetics can do. I have discussed Shell. I don't know what to do with Shell. So David's asked, I have discussed Shell. I'm not sure what to do with Shell. Shell is the Tortoise Acquisition Corporation that's had that huge spike. And that's what I was talking about earlier when I said to you guys that I just don't play acquisitions. And the reason being is because they've already got agreed upon price. Your upside, I don't know what the price is, but your upside is not, your downside is more than your upside. If this acquisition doesn't go through, support sitting at $40. Now the stock, Shell, which is Tortoise Acquisition, that stock closed at $55.85, been as high as $58. If this deal doesn't go through, support is at $40. All right, that's your first support. Your next support level looks like it's at about $30. So that's what I was saying to you guys. You have more upside than you have more downside than you have upside. That's the reason why I wouldn't do it. That's just me. All right. I have not looked at the Snow IPO. I just have not had a chance to look at it. So the first question I'm going to ask you is, have they already priced it? And it looks like this is and let's see, if I'm looking at the right company, Snow. All right, it's not publicly traded yet. So so the short answer is I'll take a look at Snow. I'm smiling because some people on here know that I really can dig into IPOs. I have not looked at Snow. I will take a look at Snow, and like a lot of IPOs, and I'll get back to you. What's interesting, though, I will give you this one. I watched this thing. I did not trade it. And I watched it basically go from, in fact, my entry point would have probably been about $25 a share. And right now it's trading at 32, 33. It's Montrose Environmental. Stock went public. What is this? On August 23rd, stock went public. So August 23rd, the stock went public at $15 a share. And right now, again, the entry point was probably right around $25. And at $25 a stock, like I said, in 2 weeks, 3 weeks, is going to 33. So that's, and I'm writing myself notes, guys. You guys told me that you want me to look at Palantir and Snow. Um, I don't know. Again, doesn't mean anything. I'm looking at this. It's not. So let me say this. I'll look into the stocks you asked me about. They have not gone public yet. So it means I have to dig into the prospectus and some other stuff, which I will do over the next couple of days. I don't have much on it. You tell me it's a great stock. It's not publicly traded yet though. So you have a symbol and you don't have a symbol on it. All right, so I'll look at it. If it's a great company, I'll look at it and make a decision. Yeah, there's a whole bunch of stocks coming. One of the things that you guys should also realize is a whole bunch of privately owned companies out here that are looking at this hot market. And because the market's so hot, they're looking to come and raise capital as quick as they can. This is the time that you want to raise capital. This is the time that you need to raise capital. You want to raise it in a hot market. If the market wasn't hot, the market's cold, you can't raise capital. So they're coming to the market and raising a lot of equity. The other thing I would say is I'm not sure what these sectors, these industries are in, but the hot area right now seems to be the cloud technology in that respect. You're also seeing a lot of IPOs coming in the pharmaceutical area, IPOs and secondaries. All right, let me see. I got those stocks. I promise you guys, I'll take a look at it. Ham, the fact that you said that snow is the hottest I've seen in a while, the fact that you said that means I'm definitely going to have to take a look at it. So I will take a look at it. All right, I'm looking at my time. You know, I got to get off before this thing runs out of time because if it does, it will shut me out and I will not be able to save the video. So any other questions that I can jump into? And by the way, as I wrap up, I'm just taking a quick look. If I can find it, I can't find it. So yeah, I can do it this. I can't do it now. I'll take a quick look at these IPOs, and I might even post a comment of the IPOs coming. For those who don't understand this, IPO's initial public offering, they're hot stocks. The one thing that everyone on this call should know is that most of us will never get a hot IPO because it's dominated by institutional investors. So the strategy I developed in terms of trading IPO stock came from the fact that I couldn't get a hot IPO stock anymore. Going back several years, when I was running the hedge fund, I had no problem getting hot IPOs. But over the course of time, competition came in and the size I was getting was dramatically decreased. But I still needed to make money. So what I did was I started formulating a strategy on how to buy these IPOs once they hit the secondary market. I have a whole strategy built around it, and that's what's going on. So even though these might be hot IPOs, like I'm just thinking right now, Lemonade was a hot IPO. Another one I missed was Big C. Big C opened up, went to $100 a share, consolidated, traded sideways, and then I think it was 2 or 3 days ago, a week ago, blew through the $100 number, ran to 132, I think it was. Hold on a second, I'll tell you right now. I thought I had Big C up here. I don't have Big C up here, huh? Give me 1 second, I'll tell you right now, Big C. The name is Big C. Cloud technology based out of Asia. So here it is. My number was 105. So stock opened up the second day, went to 105, just under 105. Then looks like about 2 weeks ago, the stock broke through 105. When it went through 105, and went to 160, 162, 163. And then, of course, the Fibonacci's and the retracement is pulled back to 112 now. We're closed today. But that's what happens when these things break. These IPOs, they can break, and when they do break, they can give you a lot of run in a short period of time. What is my risk strategy when I'm trading? I'm not a day trader, but when I take a position in this, when I take a position in a stock that's not hedged, again, I'm buying a stock and I'm trading it. When I buy it, I have 2 points, and my students heard me talk about this. I have my 2 exit points. So I'm making up numbers now. If I buy a stock at 20, my first exit point is if the stock breaks 10% below where I brought it, which I brought at 20, which means if it breaks below 18, I'm selling it. And most likely if I brought a stock at 20, I think it goes to 24, 25. So I have two targets in my mind. If I buy a stock at 20, my target is 10% below what I paid for it, which is 18. If it breaks 18, I'm out. If it goes to 25, which is my upper target, I'll readjust my numbers. What do I mean by that? So if the stock goes to 25, I'll probably raise my stop loss now to $20 a share, which is a break even for me. And I'll set a target of maybe 27, 20, about 28 or $30 a share. And if it takes out that $20 number, then I'm out. If it doesn't take out that $20 number and it goes high to the 30 number, I'm gonna reevaluate it again. Now, once I get a profit of greater than 50% on the stock, something like that, I give it more leeway. In other words, I'm not going to run my stop as tight. And the reason why I run my stop tight when I first take an early position is that's the riskiest time for me because I'm risking my capital. In other words, if I buy that stock at 20 and it goes to 18, I lose 2 points. That's 2 points of my money I lost. If I buy the stock at 20 and it goes to 25 and I raise my stop to 20 and I sell it at 20, I'm at a break even. If it goes to 30 or higher than 30, I might raise my stop to 22, 23, so I'll make some money, but I'm literally giving this thing a chance to run. So that's just me. Again, I typically don't buy anything looking for 2 or 3 points. If I'm going to buy anything looking for 2 or 3 points, then I'm going to go long 10 or 20,000 shares, get my 2 or 3 points, and go about my business. All right? But if you see me actually trading, and I'm not buying that type of size, so again, now, if I buy the stock at 20 and it hits 18 the same day, I'm gone. You can call me a day trader if you want, but I'm gone. If I buy the stock at 20 and it never hits 18, I'm sitting there long unless I run out of capital and I'm looking for something else to buy. So that's one of my strategies on risk management. The other one is, again, which we talked about, is I just hedge everything. So I use a synthetic. That's one reason why I use a synthetic. If I don't hedge it with a synthetic, I also just will go long a call or put, a straight call or put, which is the most money I can lose on a call or put is actually the premium. You know, one of the things I'm going to tell you guys, and my students have heard me say this, your goal as an investor, whether you're trading short-term, long-term, is to make money. All right, that's your goal. In order to make money, your most important asset you have is your capital, is your cash. If you give up your cash, and because you're constantly losing money and you run out of cash, we're all going to stumble across an Apple, a Google, an Amazon. We're all going to stumble across those and make some money. But you won't be able to make any money because you just gave up all your cash because of stupid trades and not protecting yourself. So your first and foremost is to make money, but the second thing is to not give back what you made. Now, I've talked to a lot of investors that got caught in a bull market. And because they got caught in the bull market, and I'm not saying that negatively, they're bull market babies. A bull market baby is someone that brought a stock, didn't have any logic behind it, just the fact that the market took it higher. You're in a bull market. A bull market is a rising tide, and the rising tide raises all ships. As soon as that tide started to go down and the market went sideways, it started to go down, which was going to low tide, they lost all the money they made. What that tells you is they didn't know what they were doing in the first place. They were fortunate enough to catch a high tide. All right? That's not what we do. Our goal is, if you make money, is not to give it back. All right? Don't give it back. So that's your inventory. The other thing too is you don't have to trade every day. I cherry pick. I'm cherry picking. Understand why I can cherry pick though. The reason why you can, and I'm saying this and I really mean this. If you were fortunate enough to have picked up the Zoom synthetic like I was just talking about, and that position, again, $2,500 turned into 60 grand, all right? How often do you have to trade? You don't have to trade every day, and you're not gonna find that type of trade every day. But again, if you did the hedge synthetic like I showed in the S&P when it was at 338, right now that thing is doubled in price. You don't have to trade every day, all right? It's not about, this is not a sporting event where you got to go out and practice your foul shots every day to get that rhythm or swing a baseball bat every day. You can look for trades every day. Doesn't mean you have to trade. All right, I got to hop, guys. For those who ask me questions about synthetics, I promise you I'll answer them. I highly recommend you go to my YouTube channel, Professor Milligan, and you'll see that I put up a video on what a hedge synthetic is. I might not answer all your questions in there, but again, it's showing what it is. You can be bullish, you can be bearish. And remember this, if you're trading hedge synthetics, volatility becomes your friend. Because if it's a hedge synthetic, if you put it on, you can go down to the penny and calculate how much money you'll lose if you're wrong. All right? That's why I like those. Also, the other reason why I like hedge synthetics is it allows you to use less capital to increase your position size. All right, guys, I gotta hop because I want to keep this recording and I don't want to lose it. I appreciate all you guys. I look forward to it. You can always DM me through Instagram if you have any questions or issues or things I didn't answer, because I typically get back to people in a really timely manner. All right, with that said, again, thank you. I gotta hop. I want to keep the recording. Have a blessed day.